Good afternoon, and thank you for joining us for today's webinar, the AHLA Quarterly International Travel Update with Tourism Economics. As you know, at AHLA, in addition to providing members with advocacy updates, we're committed to supporting the hospitality industry by providing our members with data and research to help you make better informed business decisions. That's why we partner with Tourism Economics and will continue to provide new data on inbound international travel on a quarterly basis. We're really pleased to have Adam joining us again today. During today's report, Adam's going to analyze the 2019 data released to date and also take a look at the trends for the months ahead. As many of you know, over the last couple of years, there's been a growing concern here in the industry on the number of international travelers to the U.S. and our continued loss of market share to the rest of the world, and rightfully so. Adam will discuss today that although travel for 2018 showed an increase of 3.5%, in 2019 it's steadily slowing and is now contracting based on the data from the summer. This loss of market share has a tremendous impact on our economy and also our industry. Before I turn it over to Adam, two housekeeping notes. One, if you have any questions, please type them into the QA box at the bottom of your screen, and I'll ask them of Adam at the end of his presentation. And also, please note we will have a recording of this webinar and all of our webinars added to our archive page on the members-only portion of ahla.com. Without further ado, Adam, it's all yours. Thank you.
Great, thanks. We're going to jump right in, and this is the key observation from recent data, and that is that the international travel recession is actually happening. And so while we talk a lot about the prospects or potential of an economic recession, and I'm not referring to the travel industry at large because the domestic market is doing really well, international inbound is in retreat. And we'll take a look at what this looks like first. First of all, the note is that overseas travel to the U.S. is shaping up pretty much exactly as anticipated, and we, in our time together at one of these AHLA events, we said early in the year that this year was going to be softer than last year, almost inevitably, and that's what we're seeing. That is data now through, we actually have data through August now, and we're looking at just 1.2% growth compared to about 2.5% last year for the entire year. And if you look at the shape of the way that this year is turning out, it's very clear that we are in a softening period. This is overseas arrivals year over year for each month, and I'm actually comparing two different sources just to confirm the validity of the data, and they're more or less confirming the exact same story, which is particular softness during the peak summer travel months, and that is on the overseas side. When you factor in Canada and Mexico, and this is the main difference here between the previous slide and this side, this is not just overseas, all international markets to the U.S. We've now experienced negative performance in 8 out of the last 9 months of data, right? So that well qualifies, but in the definition of a recession of 2 quarters of GDP growth. So if we want to think in terms of international travel market, we're more than 2 quarters. In fact, it looks like really 3 quarters, 9 months of almost entirely negative performance. Overall, for the year, total inbound is down 2% through July. That's where I have data for Canada, Mexico, as well as overseas. So this year is actually, when you factor in all markets, looking like we are in the midst of a downturn. If you want to look at it for major markets, I've presented this here. China, I think, is most striking because China's been in retreat, according to the official data, for most of the past year and a half. South Korea really kind of treading water through most of 2018, but then you can see toward the end of 2018 began to contract and has been in that same mode through most of the year, with a little bit of a glimmer there in August. Now, not all of Asia is down, and I suppose surprisingly, we'd say that Japan is the only major Asian market that's actually showing expansion and really bucking the trend, because growing in strength as we moved through 2019. Now, of course, Japan's coming off of years of subpar performance, so we don't celebrate too much, but we're glad to see the market rebounding a bit off of its lows. Brazil is in a faltering mode, and you really see that as you get to the summer months here. So a pretty strong 18, that's coming off of a weak 17, but weakening toward the end of 18, and then as we moved into 19, Brazil is starting to fall. And that does really follow what's going on in the weakening of the Brazil economy. You can see that the low point in terms of growth is this year. And as that's really presented itself in 2019, indeed, outbound travel from Brazil has also fallen. In Europe, the top two major markets for travel to the US, the UK, and Germany, two entirely different stories, because year to date, the UK is actually up 4.8% through August. A bit of weakness there at the end of the time period. Whereas Germany's been up and down month after month and is basically flat for the first 8 months of the year. Just to mention, I'm presenting 3-month moving averages so that it does smooth out some of the volatility, but Germany's been so volatile month by month that even then it still looks pretty jumpy. So wrap all that up. This is what 2019 looks like, region by region, in terms of percent change growth on last year. The big surprise is that Europe has actually been the leading market in terms of growth. Western Europe, 2.4%. A lot of that is UK, and as I mentioned, up 4.8. But Eastern Europe also performing well. Where we see the greatest weakness, Africa, South America, Oceania, primarily Australia. And then Asia only up 1.4, and that's because of the weakness that we noted in South Korea and in China, somewhat tempered by the rebound in Japan. And then breaking that performance down to individual countries for 2019, the real drags on growth and the culprits for the travel recession for this year are China, Brazil, Australia, and South Korea. And so these markets, and I think what's striking is that these are markets that we've, over the past decade, experienced strong growth from. China actually, through 2016, grew on average every year over 20%, right? And so here we are at actually a contraction of about 4% for the year so far from China, and the same from Brazil, and about a 3% decline out of Australia, and a 2% decline out of South Korea. That is offset, and it is offset by some of our major developed economies, Spain, Japan, and the UK, most notably. So one of the reasons that China is down is because visa refusal rates are up. And this is looking at State Department data on refusal rates for B visas. These are visitor visas. And you can see that back in 13, 14, and 15, the refusal rate was in the 9 to 10% range, but it's been steadily creeping up to now 17% of the most recent data that we have from the State Department. We're seeing in student visa rejections as well, only 3% rejections in the early part of 18, but nearly 14% rejections in the early part of 19. And so percent change, the actual issuance of visas, shows that there has been a contraction in visas in each of the past 4 years, right? And it's actually down in fiscal year 2018 about 42% from its peak in 2015. Now, the reason this is not a full-on calamity is because in 2015, the Chinese visa validity period was extended 10 years. And so that leaves a lot of valid visas in the market. But this is, at the same time, a worrisome trend. And here is the absolute value of Chinese non-immigrant visa issuance volume. We can see how far it's fallen from its peak in 2015, where it was about 2.7 million, and now approaching 1.5 million annual issues. Mexico is also a real area of weakness right now, and it's, once you get past those overseas markets, it's Canada and Mexico that are really driving the declines in a volume term, on a volume basis. We're expecting about a 5% decline out of Mexico when all is said and done for the year. And that comes off of a bit of a rebound in 18, but a particularly weak 17. Putting it into perspective, at the end of 2019, Mexico visits to the U.S. will be 7% below its 2016 peak. A very similar story in Canada, with a decline expected at around 3% for the year. We had a couple of years of rebound, but that 3% decline, again, putting it into context with the declines we also saw in earlier years in the decade, means that at the end of the year, the Canadian market travel to the U.S. is going to be down 11% from its 2013 peak. So why is this happening? Bunch of reasons. I mean, we touched on the visa issue already, but I think the other issues are here. You know, slowing global economy, weakening global currencies relative to the dollar, and then sentiment. And I've touched on these historically, but let me just give you a fresh look at how we're seeing things. Global economic growth is slowing around the world, and this is Purchasing Managers' indices for services and manufacturing. Once you get to 50 or below, it shows contraction. And indeed, globally, in recent months, manufacturing has been falling around the world. And so we see that a slowdown in Europe, particularly in Germany, Brazil, right now in recession. The Mexico economy has stalled out, and even China and India have slowed. China particularly showing a deceleration in manufacturing. And so this blue and the red line is showing manufacturing indicators for China, both of them showing Chinese manufacturing actually in contraction. So it's not just visa issues for China. And in fact, the trade war is affecting business in a real sense. This is actually trade data between the U.S. and China, and you can see that exports to China from the U.S. have fallen about 30%, while imports from China have fallen some 20% in recent months. So that's definitely part of the story why manufacturing has slowed so much in the Chinese market. Europe, some of the same story of softening as we've moved through 2019. Looking here at GDP and the red lines, red bars, you can see steady slowing as we moved into the second half of 2019. And then manufacturing, again, where we see the weaknesses, while services holding up rather well within Europe. Brexit is certainly having its effect, although you know, welcome indications today that a deal may have been reached on Brexit, but it's really affected investment in the UK. And so while the UK has held up relatively well in terms of travel to the US, it's difficult to see that market sustaining that growth in travel, given what we're seeing in the UK economy. So big picture on the economy, global GDP growth is going to hit its lowest point, its nadir, in 2019. And you can see that the most pronounced step down is in the advanced economies, but both emerging markets and advanced economies slowing down this year. But as we look toward next year, and this really influences the outlook for travel, we actually see emerging markets beginning to pick up the pace and accelerate in growth, whereas the advanced economies, and you particularly see this in the US, we expect to slow further in 2020. GDP by market, we actually do see, you know, where we see pickups in GDP, we see it in India, we see it in Korea and Australia, in Brazil, Germany, and Mexico. So it is a bit of a mixed bag. There are going to be some markets where economic growth is actually going to pick up a little bit, but that's certainly not the case in the US, where we expect GDP to fall in terms of its pace from 2.2% growth this year to just 1.6% next year. And so that weakening of the US economy is really going to define the travel market as we move into 2020. Sentiment, also an issue here. This is the percentage of households, as reported by the Pew Research Foundation, that say they have a very or somewhat favorable view of the US. And you see clear falls in that sentiment as we've moved from 2015, 2016 through to 2018. particularly for Mexico and Germany and Canada in this chart. The UK holding up relatively well, as has Japan. Interestingly, two of the markets where the travel market has also held up relatively well. And so it does seem there is some cause and effect, although it is not consistent or universal, but it does seem to be indicative that sentiment is playing a role in some of these markets and the downturns that we're seeing. Also, I mentioned the value of the dollar. Right now, the dollar is about 7% more expensive versus local currencies than its long-term average. But you can see how much it's changed just over the last 6 years. And that change over the last 6 years is really what's creating the headwinds in terms of purchasing power. And looking at that change since 2013, you see the U.S. is some 40% more expensive on currency terms alone from Brazil, 35% more expensive from Mexico, 20% more expensive from Canada, and about between 9 to 14% from other major markets. And so this certainly is an ongoing headwind for the travel market, and partly explains the softness that we're seeing this year. So what does this mean looking forward? Just a few points. The first is that the domestic travel market is basically going to save the day, because while we're seeing this, what I'm calling a travel recession in international markets, we're actually seeing real stability in domestic markets. And then secondly, the U.S. travel sector, it's in a position of strength because of high occupancy rates. Even if we were to encounter a recession, because of the levels of occupancy rates and record RevPAR, we do expect the industry to be able to withstand a recession in a way that it certainly wasn't able to a decade ago. Our analysis for the U.S. Travel Association really paints a clear picture. Forward-looking indicators for domestic, that's the blue lines, for the next 3 and 6 months, show continued growth. Whereas forward-looking indicators for international markets show continued modest contraction through the rest of the year and a bit into next year. Now, some of the indicators we look at in this forward-looking analysis are the economic data, and on that front, we are seeing strength in the consumer market. Average hourly earnings have been rising for 3% or higher. Only 1 month was it a tick below at 2.9 for over a year now. And so that's putting money in the pockets of travelers. And our view on the probability of recession is that we peg it next year at around 40%. The more likely, although only somewhat more likely, scenario is that the U.S. dodges a recession with significantly slower economic growth in 2020. And this is a big part of the reason, is the strength of consumers right now. And we see it in consumer sentiment, even with trade war fears, and a bit of a drop in consumer sentiment and expectations. If you look in the long run over the last 10 years, they're still relatively high over this entire 10-year period. And of course, consumers are happy because they're relatively doing pretty well. I mean, household net wealth is up 50% from its pre-recession high, and the cost of debt service is extremely low right now. In fact, since 1980, we haven't had a period where the cost of financial obligations has been as low as a share of disposable income as it is right now. And there are a couple things that we can credit that to. One is deleveraging, and the other is low interest rates. But both of those have made the cost of servicing those financial obligations as a share of income historically low. At the same time, the savings rate among U.S. households is about 8%, which is higher than it's been in quite a while. When we look at travel intentions, we can see that U.S. households are not taking their foot off the brakes. In fact, this is bookings of air travel for future trips over the next 3 and 6 months, all the way through August. So August data for travel for the next 3 months and next 6 months, which takes us into 2020, is showing growth that's pacing some 6% above where it was a year ago. And so we see continued momentum in terms of travel patterns in the near term. We get the same picture from data from the Conference Board. This is the percentage of households who are planning to take a vacation in the next 6 months. And in every month of 2019, including August, there's been a greater share of households saying they plan to take a vacation in the next 6 months than in either of the last 2 years. So we don't see any fault lines or chinks in the armor in the domestic market right now. So we put all that together, and this is our most recent forecast with STR. We do see RevPAR declining this year relative to last year. And that RevPAR, the upside to it is primarily ADR, soft as it is at just 1.4% growth expected for the year. Supply and demand just about balancing each other out. So just a slight uptick in occupancy in 2019. The difference in 2020 is that supply will actually outpace demand just a bit, and we expect occupancy rates to fall 0.3%, whereas ADR, because occupancy rates are so elevated, we expect it to continue to rise just a bit, nearly matching inflation. And so our forecast for international, coming back to this on an annual basis, is that we expect international for the year to fall nearly 2%. And so it will mark the first decline since 2016. But we do expect a rebound in 2020. Even with volatility in international economic and financial markets, that rebound in emerging markets especially, we expect to drive growth in the range of 2% in 2020, and then accelerating in 2021 to about 3%, particularly as emerging markets gain their footing again, and we see growth out of the likes of China, Brazil, and Korea. So just some final wrap-up points, and we'll take any questions. International travel to the U.S. has been steadily slowing. It's now contracting. That weakness most evident in emerging markets, as well as in Canada and in Mexico. Why is this happening? Trifold: a weak global economy, strong U.S. dollar, and falling global sentiment toward the U.S. But I think the encouraging thing is that the leading indicators that we track are all showing domestic markets to be holding up really well, even though international inbound weakness is likely to stay with us through the remainder of the year. On the economic front, we would say it's right to be on a recession watch, but it would be not the most likely outcome. So we're not calling for a recession at this point, particularly because of the strength of U.S. consumers, both on their income side and on their balance sheet side. So with that, I'm happy to stop here and see if there are any questions that I can answer.
Great. Thanks, Adam. Thanks again, everyone, for joining. If you have any questions, do feel free to type them into the Q&A question box at this time. Maybe we can start with one, Adam. You know, you talked a little bit about a rebound in emerging markets. Do you have any ideas on, you know, what would be some of the leading factors to that rebound that you see for 2020, 2021?
Yeah. Partly it's that what we see on the economic front, and I'll go back here to our view of global economic markets. You can see that we expect emerging markets to grow faster in terms of GDP in 2020. Another piece to it is that we expect the dollar to weaken a bit in 2020. So all those things should alleviate some of the downward pressure on emerging markets. The other thing is simply that even with economic performance as it stands, emerging markets really underperformed in 2019. And so we would expect what we would call a reversion to trend to at least partially in 2020. And that's why we get to this conclusion here at the end, where we expect a bit of a pickup in 2020. A lot of it is just getting back to what the fundamentals would indicate in inbound travel.
Great, thanks. Any others? So you talked a little bit about the steadiness of the domestic travel, are you seeing any breakdown between business and leisure? Or could you talk a little bit about maybe what you're seeing on the domestic side there?
Yeah, the stronger indicators are on the leisure side right now. Corporate profits are still strong, but down from last year, and with that, corporate investment is weakening significantly, and we see a strong correlation between corporate investment and business travel, and so business investment is going to be particularly weak in 2019 and into 2020, and so that contrast that to what we're seeing on the consumer market with incomes rising, assets in a good position, and liabilities down, and so I think the data would indicate leisure will lead the way over the next 12 months.
Great. Well, if there's not any others, thank you again for your time. Thank you to everyone for joining. A reminder, we'll have a recording of the webinar. And if you do have any questions, please feel free to reach out to me, Kaylin Stevens at AHLA, or anyone on our government affairs team. And as I was closing up, we do see one more question, Adam, just before we end. You spoke about the various countries and growth, but can you put it into perspective on mix? Put it in the perspective on mix?
I'm sorry, what perspective? Sorry?
Says, Adam spoke about the various countries growing. Can you put it in perspective on mix? I'm not sure exactly. Mix, M-I-X.
Yeah, I'm not sure what that stands for. So,
how much of the pie is China?
How much of? I'm sorry.
How much of the pie is China?
Oh, I see.
Of the growth, yeah.
Yeah. Let's go back to where we are on the overall declines, and I'll try to put that in perspective for you. Here we go. So in terms of, who are our top overseas markets, right? It's the UK, it's Japan, and then followed by China. And so, big picture here, looking at the decline that we're seeing, probably think about China only being in overseas markets representing about a quarter of the decline. When you include Canada and Mexico, you basically cut that in half, and then China only represents about 10 to 12% of the decline. So I don't think that's to say China's not by any means the majority of the decline. So it's not the dominant story here. I think the dominant story is that there are a number of markets that have fallen, and that together they're contributing to the weakness. So in addition to the ones you see here circled, add Canada and Mexico, and that's how you get to this story of this year being negative performance.
Great. One other one just came in. Are the travel agencies that promote international travel taking incentive measures? If so, do you know what they are?
I don't know of any particular incentives that are being offered right now. I do know that where we have seen certain destinations outperform the U.S. And a lot of that is actually connected to successful destination marketing programs. We've seen outperformance in both Los Angeles and in New York, and both destinations who have robust destination marketing in some of these markets. I think where we've seen some of the bigger declines is in secondary and tertiary destinations in the U.S.
Yeah. And I think, we've talked about this on on the call before, and you're very aware of it, but, as we look to reauthorize programs like Brand USA, which are up, in 2020 for funding, without having an arm to market ourselves internationally, for some of these secondary and smaller markets, we could see an even larger impact. I don't know if you have any additional thoughts on that.
Well, yeah, I think it bears mentioning because it's easy to look at some of this data and begin to feel pretty glum about international markets, is that the longer term and even medium term prospects as you get out to 2021, 2022, is that international is again going to outpace domestic. I mean, the size of the market and the growth of the market and its potential just simply is massive. And so you combine that with the need for the U.S. to be competitive against other destinations who are marketing every year, it really does put into sharp relief how important it is to have Brand USA in place, market in the U.S., developing cooperative programs with other both corporate sector and DMO partners. It's made a big difference over the years of its existence, and so the last thing we would advise is to look at this underperformance in 2019 and have that to fundamentally affect strategy, because the opportunity remains absolutely massive, and the need for competing in terms of share of voice and marketing is still as critical as it's ever been.
Great. Well, without seeing any others, we'll try to wrap up maybe one more time, but thank you again. If you have any questions, please reach out to me, Kaylin Stevens, or anyone on our government affairs team. We're happy to work with Adam and answer any additional questions you all may have. And thank you again for your time, Adam, too. We look forward to our next report with you.
Great. Thanks, everyone. Bye-bye.
Bye-bye.